Well, thank you. I want to thank the Federal Reserve Bank of Cleveland for sponsoring this, their 7th annual policy summit, and for inviting me to speak, and Sandy for that fabulous introduction. It's going to be kind of hard to live up to that one. But, I want to start, first of all, the agenda that you have for today's meeting is certainly an ambitious one. This morning you were tackling questions about how housing policy might be restructured to stabilize neighborhoods, create a more sustainable approach to home ownership. Then this afternoon you'll be talking about the Community Reinvestment Act, the CRA, how it might be revised to ensure that its continued role as a catalyst for private investment in low and moderate income neighborhoods. These are certainly important issues to consider as we try to find solutions to a very complex set of problems brought about by turmoil in the mortgage and housing markets. I don't have to tell anyone in Cleveland, where the foreclosures have harmed whole neighborhoods, about the devastating impact the foreclosure crisis has had on individuals, neighborhoods, and the broader economy. An impact that is so deep we would be remiss not to reconsider current policies to ensure that a lasting recovery and sustainable home ownership. As I looked at the agenda, I was struck by the fact that the problems we've seen with foreclosure and neighborhood destabilization stem from the over-provision of poorly designed credit, whereas in contrast, CRA had its birth when credit was generally unavailable to low and moderate income neighborhoods. So as I talk today about the Federal Reserve and our role in consumer protection, I'd like to emphasize the importance of both the availability of credit and the ability of consumers to use such credit safely to increase their own well-being in transactions that contribute to economic growth. If we've learned nothing else in this crisis, we have learned that consumer protection is not just good for consumers, it's also necessary to restore investor confidence and to promote a strong and stable economy. Given the economic events over the past 18 months, few would question the importance of the link between the performance of consumer-based financial products and the health of the broader economy. Even so, it's important to examine this link in order to learn how we can do a better job of both protecting consumers and protecting the stability of the macroeconomy in the future. The current economic situation developed over a period of years as the confluence of several market developments created an environment of inexpensive and readily available credit. Advances in information technology and financial innovations over the recent decades encouraged new lending products and the extension of credit to a wider spectrum of borrowers, including many who would have previously had difficulty qualifying for credit. Such developments as credit scoring lowered transaction costs and helped to evaluate risk more effectively and consistently. Similarly, advances in financial engineering encouraged and broadened opportunities to draw on capital from around the world through the securitization of debt. This inflow of capital provided creditors with new sources of funds for the expansion of credit. The securitization process was made more versatile, but also more complicated by the introduction of structured products such as collateral debt obligations, which were intended to match investors to various credit and prepayment risks. As the credit markets evolved, financial products also changed. Consumers were increasingly offered more complex, but often less transparent products. And where once the vast majority of mortgages were 30-year fixed-rate products, by the height of the housing boom in 2007, adjustable rate products proliferated. Products such as the 228, a loan with a low introductory rate for the first 2 years, or the option arm, a loan on which the consumer could choose to pay a full payment, an interest-only payment, or even a payment that did not fully cover the interest, with the difference being added to the loan's principal balance. For large numbers of borrowers, piggyback second mortgages substituted for down payments. These products relied on rising property values as well as the borrower's ability to refinance for their repayment. The high levels of risk posed by these products became apparent only when house prices began to fall and the rate of foreclosures increased dramatically. Just as mortgage products were becoming more complex, credit card terms, rates, and fees also were becoming significantly more complicated and difficult for consumers to fully understand. New practices evolved, such as charging different interest rates for different transactions, and double-cycle billing, whereby lenders calculated interest based not only on the current balance, but also on the prior month's balance. While such practices increase revenues for lenders, it's less clear how they benefited cardholders. Also, payment allocation rules tended to treat consumers unfavorably and made it difficult for them to fully benefit from promotions such as balance transfer programs. Even as credit products were growing in variety and complexity, consumer debt was expanding dramatically. In particular, mortgage debt rose from $3.5 trillion in 1995 to $11.1 trillion in 2007. Revolving credit grew from $443 billion to $939 billion over the same period, and non-revolving credit, mostly automobile and student loans, grew from $697 billion to $1.6 trillion. In hindsight, it's not hard to see how these various factors combine to create a perilous situation for consumers, investors, and the broader economy. Bad decisions resulting from poorly underwritten mortgage products with complex features, or worse, features purposefully hidden from consumers, were made on such a scale that the spillover effects from rising defaults and foreclosures were far broader than in prior downturns. Previously, the negative impact of foreclosures had tended to be limited to local areas experiencing significant job losses or to recessionary pressures resulting from fluctuations in the business cycle. But the accelerating growth rate in the subprime lending market and the fact that so many of these risky loans were bundled into securities set the stage so that when individual borrowers failed to keep up with payments, the result was devastating to the entire market. Investors belatedly recognized the serious problems of poor underwriting and inappropriate loan structuring, practices that may have been facilitated by securitization processes. Problems also spilled over to securities backed by credit card receivables, auto loans, and other asset classes. So as a result, investors stopped purchasing most asset-backed securities, and much of the secondary market stopped functioning. The loss of investor confidence has had enormous ripples in the economy as the tightening of credit has squeezed housing and automotive sales and threatened the viability of businesses relying on credit lines to cover inventory and other expenses. In addition to the loss of investor confidence, consumer confidence has been shaken. The collapse of the housing market exposed practices that were not consumer-friendly. Some lenders, brokers, appraisers, and investment banks were clearly motivated by the transaction fees and had little incentive to ensure that borrowers would be able to sustain home ownership. Banks, under stress from losses in their mortgage portfolios, pulled back on private mortgage lending and increased the prices associated with other types of lending. The effect of these practices, combined with the impact of job losses and other ramifications of a shrinking economy, have had a significant impact on consumer confidence. Consumer spending has fallen off as a result, further exacerbating the negative cycle. In thinking about what it will take to achieve economic recovery, I often draw on my experience as a community banker. In the days when I was lending money, we kept those loans on our balance sheet. In that context, success was directly related of the ability of customers to repay loans. Indeed, it was related to their ability to repay and borrow again over a career and over a lifetime. This was accomplished through effective underwriting and risk analysis and through proper loan structuring. When the incentives in the credit process are properly aligned, the benefits flow to both the borrower and the lender. The borrower is assured terms and conditions such that he or she can reasonably be expected to repay the loan, and the lender is paid interest on the money lent. And while I don't necessarily believe that we need to return to a time when all loans are held on the balance sheet, I do believe we need a system of balanced incentives for the longer-term prosperity of all. Credit transactions conducted to the benefit of both borrower and lender expand economic growth. And this is true on the community level just as it is on the macroeconomic level. Access to capital to create and expand small businesses leads to job growth and benefits the larger community. Likewise, mortgage lending, responsibly done, gives a community a solid base of residents with a stake in its future. The problems that we face today result in large part from a misalignment of incentives. Securitization, while providing liquidity, also weakened the incentives to properly underwrite loans, in many cases by passing default risk from the originators to investors.